C&J Capital. Today's video will be about the risks of trading options. So the risks of trading options differ than the risks of trading stocks. Trading stocks, the worst that can happen is stock goes to zero. It doesn't happen often, but that's the worst that can happen. With shorting, the worst that can happen is stock goes up, continues to go up, you lose a lot of money. These situations where, 2007, the financial crisis, the tech bubble, the flash crashes, the panics, the market crashes, but it doesn't go to zero. If the market goes to zero, you have bigger problems on your hand. Like I said, it's rare that it ever goes to zero. Look at Amazon back in 2000. It lost 75% of its value at the time. It was $5 a share. With stocks, you could hold forever. There's no expiration. You can give them to your grandkids. You can give them to your children. As long as the company is still going and still public, then you'll always have those shares. With options, they expire. There's leaps, long-term expiration options, where it goes out 2 years. And there's four main options variations that you can do, that every spread, every strategy will have. If you buy a call, you buy a put, you sell a call, or you sell a put. Those four will make up all the strategies. If you add multiple, like layers, they're called legs. Those are more advanced. When you get into positions to hedge another position, but you have it on the same trade. Buying calls, you want the stock to go up. Buying puts, you want the stock to go down. Most that you could lose is the price you paid for the contract. Let's say you bought 280 strike on Apple at next month. If Apple is below 280, if you bought a call and Apple is below 280, the contract's going to expire worthless and you're going to lose the price you paid for that contract. If it's in the money, you'll make money, sell your contracts, and then you can make money on the profit from the contracts. You can exercise those contracts, meaning you could do, if you bought the 280 call and you bought one, you'll buy 100 shares at 280, regardless of where Apple is. Like Apple could be at $300 a share. Call gives you the right to buy 100 shares at 280. The same with puts. If your contracts aren't in the money at expiration, they'll be worthless. If they are in the money, you'll make money on the contract, or you'll make money by exercising. With exercising puts, you would be selling at the strike price you picked. If you had the 280 put and Apple is below 280, if it's at like 275, you'll already be up $5 a share on your 100 shares. Let's say you do have a call. Let's say you bought 10 of them, 10 calls. You would have to buy 1,000 shares of Apple. Now, if you don't have the money to do so, you always want to close out the position. You want to just take your profit from your contracts and close it out. Because if your contracts are in the money at expiration, the broker automatically exercises those contracts for you. And you'll own 1,000 shares of Apple at that price. And if you can't afford it, then what you have to do is you sell it right away. You have to sell those shares because you're allowed like 3 days to deposit money to make up for those 1,000 shares you wanted to buy. So you would still make a profit, but you would have to sell it right away. And I think the term is free riding. It's when you sell before you have funds in the account. And if you do that too often, that'll be a violation, and it might be a 90-day restriction. The two terms you're going to need to know is exercise and assignment. Exercise is when, like I said, you do what those contracts entail. If you bought a 280 call and you're in the money, you exercise those contracts and you'll buy 100 shares at 280. Exercise the puts, it would be you selling at 280. Things about exercising options is you could do it whenever you want. If you're in America, you could do it whenever you want. In Europe, you can only exercise at the expiration date. We're in America. We're familiar with American-style options. You want to always close out the contract. Regardless if you have the money or not, what can happen, right? You could be in the money. You bought a call for SPY at 320, and they're in the money, at close on Friday, if you're confident that SPY is going to continue to be higher than 320, then you would hold on to those shares and you would let the exercise happen. But if not, once they're in the money, that means you're going to get 100 shares at 320. By Monday morning, something could happen over the weekend and those drop, but you'll still be owning 100 shares at 320. So you want to make sure that you're confident about your position before you hold on to those. But the beauty with options is leverage. Because they're leveraged, you could do a lot with a little. Like, you give somebody $500 to trade stocks, they're not going to do much with it. With options, you could trade contracts and they can go up 10%, 50%, 500%, 1,000%. In the stock market, you look at like top gainers, and some days you'll see like 10 stocks over 10% that they gained, which is a lot. With option contracts, 10% is nothing. 50%, 100%, it happens all the time. And that's what really gets people interested in options. So next we'll go to selling a call. When you sell a call or sell a put, it's more of a income strategy, because the amount you can make is capped at the premium. For buyers, if you're buying a call or buying a put, you're paying the premium and you can make substantial, it doesn't matter, there's no cap. When you're selling a call or put, it is capped, and it's the most you can make is that premium. The reason why that's still attractive to people, if you do it right, you could make an income every Friday you put on. Calls or puts you sell are out of the money, you'll always make an income. So an assignment is when the other side of the trade, the buyer of those option contracts, exercises their right to buy if it's calls or sell if it's puts at that strike. And you have to deliver the terms of that option contract. You have to make up for those shares that they want to either buy or sell based on your selling of call or put position. So selling a call is a bearish strategy. You want the stock to go down. The worst that can happen, let's say you're selling a call, right? 100 strike call. If it goes above 100, you're still going to have to sell at 100. You want to sell a call at a lower spot. You don't want to have to sell at 100 when the stock is at 200. That's a 100-point difference that you're going to have to make up. And if you do the other side, the selling the put, that means you're going to be buying at a lower price. The main thing with selling is you want the option to go worthless. If they become in the money, it's risk of being assigned. Because at any time, like I said, they could be exercised. And if they're exercised, you have to make up for them. That's your obligation as a seller. It's unlimited risk. But to sell a call or sell a put, you need the collateral. If you're selling one call, you need, let's say you're selling one call at 280 for Apple, they want you to have 28,000 in your account for you to do that. If that worst case scenario happens where you have to pay for it, get assigned, they're going to have to, they want you to have some money in there before you take on that kind of risk. One of the worst things that can happen to new options traders is that they win. And not only do they win, but they win big their first couple of trades. Because what happens is if you win early on, is you get this false confidence in your ability to trade options. They'll think they're the man on campus, Anything you do, right? Well, if you're good at something early on, you're going to push yourself. You're going to take more risks, you're going to go for it. With options or trading in general, if you think you're good early on and you get this confidence, what do you think you're going to do? You're going to add more money. You're going to keep adding money because, hey, if I could do this with this little amount, if I had more money, I could do it a lot more. I mean, I can make, my profits could be crazy. Say, okay, I'm going to risk more because it worked out this one time. I'm going to risk more and I'm going to make more. And what happens? You blow up your account. Be humble. But you will take losses. I've seen, there was this forum online where I was reading, and this guy had a portfolio with Goldman Sachs, professionally managed. and with them, they showed all their positions. They said, okay, this is what we plan on doing next month. This is what we did last month. And they showed Goldman Sachs's like trades for the year. The amount of losses that you could see in these big time firms, like all I heard before was the smartest people on the West Coast, they work at Google. The smartest people on the East Coast work at Goldman Sachs. These people at Goldman Sachs are PhDs in physics and economics and math, and even they take losses. Whenever you do something new, if you're playing guitar, training MMA, or learning how to cook, you're gonna suck early on. Maybe when you're learning to cook, your food sucks and you may turn people off from your cooking, but you'll grow, you'll get better, and eventually you'll be a good cook. If you're training MMA, if you're in a good school, the worst that's going to happen is you're going to get beat up. Well, that's a bad example, because if you're in a good gym, you'll always get beat up. With trading, you're going to suck early on. When you suck, you're going to lose money. I'm not saying you need a lot of money, but you need enough money to go through the learning process before your money runs out. And not a lot of people could afford that, because, like I said, other hobbies, the worst that can happen is you're embarrassed. With trading, when you're not good, you lose money, and not everybody could afford to lose money. So you need to keep in mind, take it slow. You're trading options, it's leveraged. You can do a lot with $100. You don't have to jump in with $1,000, $2,000 right away. Take it slow, humble yourself. It's more important that you stay in the game, trade small, learn, make sure that your money doesn't run out before you learn how to trade. And it could take years before you learn how to trade. So always keep that in mind. Just hold on to that money. Don't let it go. Don't blow up your account trying to get rich quick. E&J Capital.